Markets rebounded after a fresh report on hiring reveals a much stronger labor market than economists expected. But Treasury yields remain at their highest level since 2007. How will the Fed react, and what should investors be watching? Joining me now is KKR Balance Sheet CIO Henry McVey. Henry, thank you so much for joining us today.
Thanks for having me.
So first, let's dissect this jobs report that we got. Blew past all expectations. What do you make of it?
Couple things. One is the services economy is still roaring hot, and you see that in professional services, healthcare, as well as leisure and hospitality. Those jobs are actually still below pre-COVID levels. The good news, and why I think you got a positive market reaction today, though, was the wage growth was a little more subdued. So the Fed is not going to be done with their job until they temper some of the wage growth as well as the overall labor force growth. And so that's where we're going to go. Right now, I still think the upward bias is towards higher yields, and we'll have that until labor starts to settle down, which we do think happens in 2024.
So I'm glad that you talked about that higher yields bit, because that also certainly was the story of the week, actually story of the year, with yields approaching 2007 levels. Just curious, how much of it is the effect of the Fed's actions? How much of it is maybe some of the chaos that we've been seeing in Washington recently, the risk of maybe a credit downgrade? What are the dynamics that are affecting what we're seeing in yields now?
I think the first thing that most of your viewers are probably not paying attention to is actually international holders of bonds, Japan and China. They have been selling bonds. So that's a technical where there's more supply. Second, as you mentioned, there's been a lot of chaos in D.C., but I think fundamentally we're actually running with the highest deficits outside of war since before World War II. So the market is reacting to that. So you've got strong fundamentals in the form of growth, but you also have you've got, I would say, less than spectacular technicals given the supply coming on with bigger deficits, as well as international holders owning less treasuries. And I don't think that goes away. So again, I get back to the fundamentals need to improve for the bond market. Unfortunately, that probably means slower wage gains as well as slower overall growth. So there's a balance the Fed's trying to strike. I think we'll get there, but I think it's going to take a little more time.
There was something you've said in your research recently, which maybe ties to this, which is this notion of regime change that's playing out in the economy and markets. Can you spell that out for us?
Yeah, I think our view at KKR, and this is something we've been highlighting, is this regime change, which is we're moving from low growth, low inflation to one of kind of higher growth, higher nominal GDP, where there's a little more inflation in the system. And it's driven by four factors. One, as we saw today, labor and wages are still growing. Two is bigger fiscal. Both the Republicans and the Democrats are spending. Three is the energy transition is actually bumpy and leads to inflation. And the final one is geopolitics. As I travel around the world, supply chains are starting to move to Vietnam. They're starting to move to the U.S., Mexico. That's leading to less efficiency. And those four drivers, those are the key things that lead to our regime change. And it means that investors need to think about how much they own in stocks and how much in bonds. We're particularly concerned on the bond side, and we've tried to create products for investors that help them get that yield without some of maybe the duration or volatility associated with traditional fixed income instruments.
Is there a proportion of holdings that makes sense on that stock bond or bond-like investment mix?
Most people have been at a 60-40. That's typically what you'll hear quoted. We would have a much lower percentage on the bond side. I think there are other things you can do around owning things that are linked to the growth in the economy, that have yield, that have cash flow. And so things around housing, or what we call asset-based finance, or just general infrastructure. Infrastructure does really well in a stronger economic growth where you have some pricing power and it's able to pass those costs along. And so I think for individual investors as well as institutional investors, you have to think differently about our regime change thesis.
Gotcha. And one of the other things that we're seeing, maybe part of this regime change, is energy. You have recently said that $80 is the new $60. How scared should I be? What does that mean? What's the opportunity?
I think if you follow our stuff, what we've been saying that people are going to be too bearish on supply of energy, and that's probably proved out faster and more furious than what we thought. But what you see is when you have energy transitions and we're moving towards a more decarbonized world, what happens is companies don't invest in much in the existing energy, and that has created a supply-demand imbalance. And so what it means is you probably have a higher resting heart rate for energy, and that's part of our inflation call. So unfortunately, I think that's the reality. It's probably, oil went up to closer to 100 than the new 80 that we've said, but I think we do settle down at a higher level, and that's something we all probably need to think about as we fill up our cars or we think about our houses or overall economic budgets. And I think it is a new reality.
Well, thank you. You basically have taken us around around the world. I know you've had some travel in China and Japan too. We'll have to talk more next time, but understanding that you're seeing some opportunities there. So thank you so much for your time today, Henry.
Okay, thank you.